Good evening. This is Keith Johnson, CPA, with the tax update for March 24th, 2021. We're continuing our series of discussions on the American Rescue Act, which was passed a couple weeks ago by Congress and signed by the President. There's a lot of areas in this act. I want to discuss a couple of them today. One is the child tax credit, and two, student loan interest. They're both a little smaller, so I'd figure I'll combine the two. First is child care credit. Now, child care credit is a prospective feature of the new law, which means that it's not going to take effect in 2020. So the changes that have happened or that are going to happen will not affect your 2020 return. Now, child care credit has been around for many, many years, and basically it's an incentive for working parents to, get child care for their kids. And this one's a little bit more generous, I would say, than some of the others. Now, there's a couple parts to it. In the past, it's been a non-refundable credit. Now, if you've been watching me, I've mentioned the differences between a non-refundable credit and a refundable credit. Non-refundable credits are credits that are, that you have to have tax in order to use the credit. So, you figure out your taxable income, and if you have taxable income, then generally you're going to have tax, and you have to have that tax. Now, this is not the final tax bill. Like, you still might get a refund. Even though you owe tax, you may still get a refund if your payments and your withholdings exceed the amount of tax that you owe. So that's very possible. But we're talking about the tax that has to be paid by either your withholdings or your or estimated payments. So if you owe tax, then you can use the credit to offset some of that tax. Okay. Whereas if you have a refundable credit, you will get that credit whether you owed tax or not. So the way it worked was that before was that you had a $3,000 credit. So it's $3,000 per child with a maximum of 2 children. So that means that the maximum credit you could possibly get is $6,000. Now, pretty much nobody's going to get $6,000. But what that is the $3,000 per child base, or the $6,000 total base, is multiplied by a factor depending on your income. Now, so what you do is you take your actual child care expenses, and they have to be legitimate expenses. You have to have a receipt from a professional caregiver if you're like going to a daycare or extended day or whatnot, or you have to have the Social Security number and address of a caregiver. Now, we're talking about a professional caregiver as opposed to a 15-year-old girl who's going to do babysitting. You give her $20 for the night. We're not talking about that. We're talking about people who do this legitimately more than very part-time. So what you do is you take whatever your expenses are, and then you multiply them by a factor. Usually, I think the lowest one for people with very little income, it's about 40%. And at the very top end of the scale, if you have a high income, it's 20%. I like that because everybody gets to take part in it. It doesn't totally phase out. I mean, it gets less, but it doesn't totally phase out no matter how high your income is. So let's say you had a couple $1,000s in taxes or in child expenses. You paid to your school for extended day. They give you the receipt. You take it to a CPA or other tax preparer, and based on your adjusted gross income, it's going to be multiplied, let's say by 25%. Just depends on your income. So if you spend $2,000, multiply that by 25%. Depending on what your income is, then you'll get a credit of $500. And again, generally the credits max out at $600 per child. The $3,000, the $6,000, that's the expense based, but the actual credit that you're going to get caps out at $600 per child. So the most you're going to get is $1,200. So, so you report that on your Form 2441, which is attached to your 1040. So, it's not a big windfall, but you're gonna get something back, and every little bit helps. Nobody's going to think anything less of you for doing that. So, anyway, that's how it used to work. Now, the theory is still going to work, but there's still going to be some changes here. So first, they are going to raise the maximum factor from about 40% to 50%. Also, they're going to raise the maximum amount from $3,000 to $4,000. Still going to be capped at 2 children. So the most expenses that can be used to calculate the credit is going to be $8,000 if you have 2 children. Now, another change with it is that it's going to be a refundable credit, at least for 2021. So what that means is you will be able to claim it regardless of taxes owed. So that's a good thing. Also, the phase-out provision is going to kind of change a little bit. So what they're going to do is that it used to be, I think, what was it, 43,000 that you hit the 20%. That was the maximum or the minimum income. So if your income was over 43,000, then you got to use the factor of 20%. That is going to go up to 120,000 for married filing joint. So that means that if you, instead of less than 43,000, you get the 20%, and it goes up as you go down from 43,000. But that figure's changed to 120,000, so you're going to drop it from from the income. When you drop it from there, the factor's going to go up from there, not 43. So it's quite a bit more, so more credit's going to be eligible. Also, the factor will drop below 20% if you make over 400,000 married filing joint. So if you have, if you're really high income, then whereas before you would still get the 20%, you might get less. I don't think there's a total phase out, but you do want to look at that as some kind of planning strategy. Now, again, that will take effect for 2021, and at least it'll go for at least that year, maybe a little longer. I don't know yet. I haven't gotten that word. Now, with the other issue, which was the student loan deduction. Now, student loans, you for probably 10 to 12, somewhere around there, years. When I started practicing, you could deduct 65% of your student loan interest. And about, I think in 2008, they switched it to 100%. So you can deduct all of your interest up to $2,500. Now there's a phase-out range there, and it's usually phases out in the low 100s. It's where it's always been. So if you're married filing joint, phase out is right around 130 to 140, 100,000. Now, here's the deal, the way it's going to change. Now, generally, you could still write it off And the rules on the student loan interest really haven't changed. But here's the key point about your student loan. If you have forgiveness, so let's say for whatever reason you have student loans forgiven, and from my understanding, that's very tough to do. But if you are discharged, and generally if you are discharged from a loan, you get what's called a 1099-C, which is cancellation of debt. Now, that cancellation of debt is counted as other income on your 1040. So it's going to be counted on your Schedule 1 about line 9. So you're going to have to, so like, let's say, for instance, you had some credit cards that were, you kind of went into an agreement. So let's say you did that, and you had $12,000 of credit card debt forgiven. Okay, well, the credit card company is going to give you a 1099-C for $12,000, and you are expected to put that as other income, as the IRS considers that other income. Now, there are a few exceptions. One, if it's, and I'm not sure if it was restored, but for tax years before 2018, the indebtedness on your primary house, so if you did was excluded from income. So what that means is if you went into a short sale or went into a foreclosure or something and you had your debt forgiven, the difference between the fair market value and the actual amount owed, you got the 1099-C, but you could exclude it. Okay. There's another major exception to that rule, and there's the insolvency exception. Now, generally that applies only for, it's not applied for the income, it's applied for the taxes generated by the income. If you go to, it's Form 9464, I believe, or actually Publication 9464. If you go to www.irs.gov and type in, and go under Forms and Publications and type in cancellation of debt, you should get that 9464. On page 6 of that publication is what's called an insolvency worksheet. Now, the insolvency worksheet works like this. At the time the debt is forgiven, on that date, you take your total assets and your total liabilities, and you add up your total assets and you add up your total liabilities. To the extent that your liabilities exceed your assets, you are underwater. And that is the amount that you can exclude the tax based on the forgiven debt. So what that means is that, let's say, for instance, you had $12,000 of student loan debt that was, forgiven. And let's say you are in the, let's say the 22% bracket. Okay. So you take $12,000, multiply it by 22%, and my Florida State math should say it's probably about $2,640, give or take. If you're in the 22% bracket, that means that the additional $12,000 of forgiven debt equals about $2,640 of additional tax. Okay, so you fill out the insolvency worksheet, and let's say, for instance, you add up your debts or your assets, and they turn out to be $100,000. Let's say you add up your liabilities, they add up $110,000. That means you are $10,000 in the hole. So what that means is that you can exclude up to $10,000 of taxes generated by the forgiven income or forgiven debt. So, you have $2,640, that's less than $10,000, so you can exclude it. Now, in order to do that, you file what's called a Form 982, reduction of tax attributes, and attach it to your 1040. Okay, if you have any kind of principal primary home indebtedness, that's where you get it forgiven. Went a little bit off topic, but I just wanted to explain how that worked because you might need to know that. But at least for student loan interest or any student loan forgiveness for 2021, it's not counted. You're not going to get a 1099-C. So that's going to be a big relief for everybody. There's other stuff to do, so I will come back tomorrow. What I'm going to do, what I've been trying to do tonight too, is set up my laptop to do this. So tomorrow you might be getting a little different perspective. It'll still be me. It'll still be giving good tax advice, but just the layout may be a little different. But I have set this up to stream, so I think it kicks in tomorrow. So we'll try it out. If it doesn't work, we'll do it by phone again. But I'm learning. I become a little more tech savvy and make it easier for me to bring good information to you. So we're going to continue to work on this and hopefully grow it. I did check. There's a few people that found me on YouTube. I put in some keywords and apparently, a couple people found them. So I appreciate it, and hopefully you'll see this video. You weren't turned off by the last one. Anyway, so until tomorrow, have a good evening, stay safe, and God bless. Take care. Bye.